Hello everyone, I'm Mark Wright, Director of Business Development with SC Biz News. We are the media company that serves 100,000 business executives throughout South Carolina. Welcome to another edition of Coffee With. Today I'm having coffee with John Price, CPA member, Tax Advisory Services with Scott & Company. John, thanks for coming.
Appreciate it, Mark.
So before we get into the tax questions and interview,
Sure.
Tell me a little bit about yourself. Where are you from? What are you doing when you're not tax advising? Things like that.
Yeah, well, I'm originally from South Carolina. I'm in a small town called Parksville, which is near Augusta, of course, in South Carolina. Grew up there and went to Clemson, and then started out in public accounting in 1988, and been practicing in public accounting since then. In the tax world, but one of the things I'm doing this time of year is officiating high school football games. So I always look forward to this time of year.
And how long have you been
officiating? This is my 20th season.
Wow. Okay. Heard some things, seen some things is my guess.
Yeah, you can say that again.
Yeah, I get it. Okay, so let's talk tax. So
Sure.
Initially, what tax legislation was passed in the state of South Carolina this year that actually saves South Carolina taxpayers federal income taxes, operate an active trade or business?
Yeah, so obviously a lot of times taxpayers think, oh, everybody's just after my wallet. And so this was a very taxpayer-friendly legislation that essentially, for those people who understand their personal tax needs, there's the SALT limitation for itemized deductions. You can only deduct up to $10,000 of state and local income taxes, property taxes, etc., on your personal return. So that limitation has caused a lot of people to not be able to itemize, even though they've paid well above $10,000 in that category. So South Carolina recognized this problem and said, hey, well, let's see if we can figure out a way to help out some of our taxpayers. So what they've done is they said, if you have an active trade or business and through a pass-through entity, which is an S corporation or partnership, you may elect to pay the South Carolina tax associated with that income at the entity level, or i.e. the business. Let them pay the taxes. Then you wouldn't then pay the taxes on your return, but that entity would then get to deduct those taxes against the income, so that basically that deduction that you're basically losing on the individual side would get picked up on the corporate, and therefore you get that deduction. So that can save you up to 37% of whatever that tax number is. The state is getting the same amount of money either way, and so it doesn't hurt them or it benefit them, but it does benefit the overall tax burden of our citizens as far as that particular legislation.
So if I'm an individual and I don't have a trade or own a business, after 10,000, am I kind of
well, in other words, you lose out on the fact that, let's say your property taxes and your state income taxes total $14,000. On your individual return, you're only allowed to deduct 10 of that. And then you have to take that 10 and add that in with your mortgage interest and your charitable contributions. And if the sum of those don't exceed your standard deduction, then you take the standard deduction. If it does exceed, then you get to itemize. But so you basically lose $4,000 in this case of itemized deductions that you would have otherwise had it. And if that $4,000 happens to be attributable to that active trade or business, now you get that $4,000 against your federal income that you wouldn't have otherwise.
Understood. Okay, what are a couple of red flags that might cause individuals to have a federal return audited by the IRS? Because going into tax season as an individual, that's what I fear.
Yeah, no, a lot of people worry about certain things, and one of the things that I tell people is, look, if you have a small business, i.e. a Schedule C business, it's something like you just do on the side, the IRS is going to be looking at you and saying, hey, how come you continue to lose money at this? Is this really a business or is this a hobby? And therefore, we don't like hobby losses. We're not going to let you deduct those. So if you have a loss on that, say for 3 out of the last 5 years, that's a flag. And that's going to say, hey, this is maybe not a business, but more or less somebody's hobby. And you can only deduct expenses against income up to the extent of that income if it's truly a hobby. So you can't generate a loss that you could then deduct again, offset other income like your W-2 or interest and dividends. So that's one that you have to be weary of and say, I need to make sure that I'm not losing this. Or if I am, it's okay, but you better have your ducks in a row and saying, hey, why is this? So that in case you get audited, you can say, well, this is what happened, IRS, and this is not, my intention is to continue to lose money. One of the other ones is, it may not be applicable to a number of people, but I've seen this more often over the years and if you have a foreign bank account, just maybe not anything that you probably opened, but maybe you inherited, or you work for a business that operates overseas and you have some signature authority over that foreign bank account. If that foreign bank account has at least $10,000 in that account at any time during the year, there's a specific reporting, it's called the F-bar, and you have to let them know, hey, I had this, here was the value. It's not a big deal, but it can become a big deal if you don't let them know about it, because now they're thinking you're trying to hide something. So if you have that, you need to talk to your CPA or look into, how do I file this, what we call F-bar return.
So if you're an individual and you have this hobby or side business, and does it matter how much income you have from that side business for the IRS to go, this is a business or this is a hobby?
No,
and then throw up a red flag thereafter?
No, not necessarily. It's not the amount of the income, but it will, because one of the things you have to put on that schedule is kind of what type of business this is. So they'll be able to look at that code and say, is this a cash intensive business or not? And if it's more cash intensive, that's more of a red flag, because obviously they're thinking, well, that's something that may not always get reported. So you have to there's a number of factors there, but the total income doesn't necessarily raise a flag as much as having losses consistently. That's when they're like, what's going on here?
Right, and clearly what kind of business it is.
Correct.
If it's cash intensive, that's more of a red flag potential.
Exactly.
Gotcha. No? Okay.
No, yeah, no, you're right. You're right. It is. It's just, and we see, I hear about this all the time. I mean, and this is, I'm not sharing anything that nobody else knows. Is a lot of times you can't get work done because without somebody saying, I don't want you to write me a check.
Right.
I only take cash.
Right.
And then, you have to get it done. You have to get it done. So then it's on them to decide what they do about that. But
right.
we hear it all the time.
I understand. So how long should I keep my tax records for? I've heard 7 years. I've heard longer, but
yeah, no.
What's standard?
Well, 7 is probably the number because technically the statute of limitations under normal circumstances is closed after 3 years. But they can go back to years 4, 5, and 6 if they can prove that you substantially understated your income.
They being the IRS.
Correct. After 6 years, there's only 2 ways that they can come back on you. A, you didn't file a return, or B, the return you filed was fraudulent. So as long as you know you filed a return, so that checks that off, and you weren't fraudulent, then after 6 years, it's pretty much done. So that's why we tell them 7 years. You can all the records, you can trash them, shred them. The returns, whether it's up to you, whether you want to kind of keep the return itself. Now, there's certain things that you don't want to get rid of because it may be something that's going to carry over and continue on, like you bought a piece of property and you're renting it, and that's something that you've been renting, say, for 15 years. Well, the IRS may at some point show me how much you really paid for this property, and then you'd have to show them that say that closing statement. It proves what you told them that you initially paid for it, and any improvements that you would have made over the time.
Got it. As an individual taxpayer, what are my worries, if any, that my information could be hacked through the IRS?
Well, obviously their securities and protocols have gotten stronger over the years. In fact, what happens sometimes is we'll try to electronically file an individual's tax return, and it'll get rejected. I'll have to look and say, why was it rejected? It'll say, well, a return has already been filed using this Social Security number. Well, then it's like, obviously I know who my client is. It's not them. Somebody has filed a fraudulent return under their social. So then we have to paper file because it won't go through electronically. And then the IRS, after, digging through the records, they'll find out, this person who filed the paper return, this is who they really are. They will then assign them a PIN that they have to give their preparer every year to put in there for the electronic file so it'll go through. Because if they don't put that PIN in, it'll get rejected, saying, hey, IRS has issued a PIN, we need to see that PIN. And you get that every year. It's not the same. It's like either 5 or 6 digits, and they give you that every year. You get a letter from them in January saying, here's your PIN for this year. This year, they decided, hey, we're not going to just leave it to those people who have already been a, quote, victim of tax identity theft. We're going to we're going to open it up to anybody who wants one. So you can voluntarily ask IRS, hey, I want you to give me a PIN just for that little bit of comfort level. And then, again, like I said, every year after that, you'll get this letter. It says, here's your PIN, and then you have to either, if you're doing your own return, you enter it in your software or you give it to your CPA or preparer. So that's it's another level of security that the IRS has given folks who have not been a victim, but they want to try to avoid it.
Interesting. Okay. Do you have a lot of clients that ask for the PIN?
I've had a couple so far that have, had other issues, say a credit card or whatever, and they're like, oh, it's happened to me over here, I want to avoid it over here. And so they've gone and, applied for it.
Tell me, what are a few year-end tax planning ideas which a business or an individual should know about?
Okay, well, a lot of these are nothing new because there's not been any real new legislation, and frankly, I'm not sure we're going to really get any this year, to be honest with you. But, if you're a business and you've got a need for some equipment and you can get it placed in service by the end of the year, it's time to go get it. I know with the supply chain problems we have now, it may be harder to do so, but you can get that equipment in, and then if you're profitable, you can take an immediate write-off of that up to, say, it's like at least $1 million of a write-off immediately. For individuals, if you're going to itemize your deductions, or you're going to be close, you might want to accelerate some charitable deductions. It's getting on toward the end of the year, and you're going to be borderline one way or the other. You might want to just say, hey, let me do that. Or even a better idea, if you are retired and you're having to take your required minimum distribution from your retirement accounts, there is a way for you to give money directly to your charity of choice, and then that amount doesn't get shown as a charitable contribution in your return, but it reduces the income that's taxable. So it's a win-win because you don't pick it up in income, and then you're basically getting to use that standard deduction that you wouldn't have, because you're not going to quite itemize.
So if I'm a business and do you have to have the equipment or the expenditure that you're trying to write off profit with? Does that have to be in-house before year end?
It needs to be. It has to be in-house and supposedly in service. You're supposed to be using it by 12/31. You can't just have it shipped in and then it's sitting on the floor and you hadn't done anything with it.
Or even less, you've paid for it, but it hasn't
gone
anywhere yet.
Yep, that won't work.
Okay.
That won't work.
So it's got to be in-house and,
correct,
in theory,
in service,
working.
Mm-hmm.
Got
yep.
it. How much value can an individual give to another person in a year-end to avoid having to report a gift on their income tax?
You can, an individual can give another individual up to $15,000. I say value, I mean, a lot of people think cash, but it could be stock, it could be anything. It's $15,000 of value that they then at that point can use. Whatever they want to do with it, it's theirs. And then you don't have to file a gift tax return. Now, some people think, oh, well, what if I gave somebody 20? Well, that's okay. You still file a gift tax return, but you probably won't owe any gift tax. You're just basically telling the IRS, hey, I gave somebody $20,000. I get the annual exclusion is what we're talking about. You take 15 off of that. So then I gave $5,000 that's, quote, subject to the gift tax rules, but then you have this currently over $11 million exclusion, so that 5,000 would just kind of come off that 11 million. You don't owe any gift tax. And the recipient of the gift, I have this question a number of times, is this income to me? The answer is no, it is not. It's just a gift. So that is not income to you whatsoever. So I mean, if you wanted to write me a check for $1 million right now, I'd say thank you, and none of it's taxable to me.
As long as I declare it as a gift.
Correct.
But I give you $1 million and I don't declare it as a gift, that's a different animal.
Well, you could possibly run into problems later on, but you still probably wouldn't have a gift tax. You just need to report that to the IRS.
Gotcha. Okay. John, thanks for coming in. I want to thank John Price from Scott & Company for coming in today for another episode of Coffee With. Thanks for watching, and we'll see you in the next episode. Thanks.